All right. Good morning, everybody. My name is David Wright-Smith. I work for the Minnesota State Retirement System. We're a state agency overseeing the Minnesota Deferred Compensation Plan. Joining me today are some of my coworkers and counterparts, Mark Mannion from MSRS and some technical experts from Voya. We have Adria Campbell, and Adria, will Jim be joining us as well?
At some point, yes.
I'm here.
So Adria Campbell and Jim Gulak, thank you for joining us as well. We're partners in learning about and implementing this provision of the Secure Act 2.0. So thank you to all of our participating employers for attending this session today and learning about how to implement this new provision. What we're going to talk about today is the Secure 2.0 Act and Section 603. So Secure 2.0 was some federal legislation passed a couple of years ago, making some significant changes to retirement plans. Lots of different retirement plans, lots of different provisions, and lots of different effective dates. And this particular provision, 603, is effective January 1st of 2026. So we're going to discuss what that means, what we have to look for. We'll give some examples of how this is going to affect what we do and what participants this affects, how to be in compliance with this provision, and some key takeaways, some action items for you, and we'll provide you with some resources. So we've got resources on our website, contact information, some resources you can print out and refer to and have to make sure that we're all in compliance with this. If you would like a copy of today's slides, in the reminder of today's meeting, there was a link. The slides are also posted on our website, and I'll show you where that is near the end of the meeting. And then at the end, we'll have a Q&A session. So if you do have a question, please jot it down so you don't forget about it. But a lot of your questions are probably going to be answered within these slides. But jot down that question. If you want to put that question into chat, you certainly may. But at the end, we'll allow you to raise your hand, unmute yourself, and ask your question at that point. And of course, you can always contact us later as we're working through all of this together. So this new provision that's effective January 1st of 2026, Section 603, requires that age-based catch-up contributions be Roth for some participants. Now, I'm going to define all of these terms as we go here, but that's basically what it says. Age-based catch-up contributions have to be Roth for some participants. So Secure 2.0 requires that age-based catch-up contributions be made as Roth if a participant's prior calendar year wages exceed $150,000 with the employer sponsoring the plan. Now that limit or that cutoff of $150,000, that's subject to annual cost of living adjustments, so that's likely to go up in subsequent years. This provision is effective January 1st of 2026 for 401ks, 403bs, and governmental 457 plans. As a governmental 457 plan, we are required to make a reasonable, good faith effort to comply with this provision in 2026, so that when 2027 comes around, we've got all the bugs worked out, all the kinks smoothed out, and that we're in full compliance in 2027. So we're going to tackle this now, work with you, and get this in place so that we can be in compliance for 2026 and beyond. What this also means is that all participating employers, all employers that utilize the Minnesota Deferred Comp Plan, must offer Roth. So Roth has to be, or Roth or after-tax contributions have to be authored within your payroll system. If you need help, questions about that, certainly contact us. The changes that are happening with this provision apply to age-based catch-up contributions starting in January 2026. So the impact of this provision is on participant contributions to the Minnesota Deferred Compensation Plan. So those participants who have FICA wages greater than $150,000 in the previous calendar year must be identified. And FICA wages, for the purposes of this provision, are wages subject to Social Security tax. So box 3 from Form W-2. Now, if you read between the lines here, you may have some employees that don't have FICA wages. The majority of state patrol officers, police officers, and firefighters in Minnesota aren't subject to the Social Security tax. And so they would be exempt from this provision. It's just those who have FICA wages. Age-based contributions are those over the normal limit. And I've got a great chart for you on the next slide. So any contributions made over the normal limit for those who are age 50 and over, or those who are ages 60 to 63. That's a new provision that was added January 1st of 2025. There's a new age-based category. Let's take a look at that chart. So the standard contribution limit, this is for 2026, $24,500. A participant may contribute to the Minnesota Deferred Comp Plan $24,500. And that could be pre-tax or Roth after tax or both. As soon as they hit that limit, if they are age 50 and over, and that's the year that they attain age 50. They don't have to wait until they turn age 50. It's the year they attain age 50 or their age at the end of that calendar year. That year and every year after that, they may contribute an additional $8,000 or a maximum contribution for next year of $32,500. If that participant is age 60 or reaches age 60 in a particular year, age 60 at the end of that year, ages 60, 61, 62, and 63. So for those 4 years, that participant may contribute an additional $11,250 over the standard contribution limit. Everything always goes back to that standard contribution limit, $24,500. That additional $11,250 brings them to $35,750. Those are the age-based catch-up contribution limits that we're going to be concerned about that have to be Roth contribution for those individuals that we're talking about. There is another provision called the 3-year special catch-up. That's something that participants can apply for and must be approved by MSRS. And participants can contribute an additional $24,500 over the normal contribution limit for a total of $49,000 if they have enough catch-up credit to do so. I'm talking about the special catch-up provision and pointing that out because that is not subject to this Section 603 provision. The special catch-up can be contributed all pre-tax, all Roth, or combination of the two. What we're focusing on today is those two middle categories, the age-based contribution limits, age 50 and over, and ages 60 to 63. Here's a couple of examples of how this works. So we've got participant A. That person is age 55. So they fall into the age 50 plus category. Last year, they earned $160,000 of FICA wages. And so therefore, we have to look at their contributions once they reach the normal limit. Their first $24,500 can be pre-tax or Roth after tax or a combination of the two. That first dollar after the $24,500 must be made on a Roth or after-tax basis. Now, Roth is not better, it's not worse, it's different. It means you pay taxes now instead of later. So it's a timing tool, but it's going to be a change for some people. Some people might not want to do Roth. Some people might want to do all Roth, but those contributions for those employees must be Roth or after tax. Example number 2, we've got participant B, who's age 62. They fall under that 60 to 63 contribution limit. So that participant who's age 62 earned $175,000 in the previous year. Their first $24,500 can be made on a pre-tax basis or raw after-tax basis. $1 after that, all the way up to $35,750, must be made on a raw after-tax basis. Third example here, we've got participant C. That person is age 67 and made $180,000 of FICA wages in the previous year. They've been approved under the special catch-up provision, the 3-year special catch-up. They may contribute up to $49,000, all pre-tax, all raw, or a combination of the two. We don't have to watch that participant when they reach the normal limit of $24,500 and worry about if anything after that is raw. They're not subject to this provision. So what do we do to be in compliance with this provision? Employers need to identify those employees. So employers need to provide a mandatory raw catch-up indicator. That's what we're calling it, the MRC indicator, to VOIA annually for those employees that meet the requirements. Providing this MRC indicator is done in VOIA PayCloud within the sponsor web portal starting in January of 2026. You will provide a Y if that eligible employee is an MRC participant. In other words, they had FICA wages greater than $150,000 in 2025. Those MRC indicators should be provided annually, ideally by January 31st. Updates can be done throughout the year, so updates will be accepted. If you identify somebody who you missed or need to make a change, you can update that at any time. Those MRC indicators will remain on file until the employer provides new information or some sort of mid-year update. What does that do? That MRC indicator will VOIA will use that MRC indicator to prevent or correct pre-tax contributions in excess of the limit. So it's a safety net to help you be in compliance or catch when you're trying to remit pre-tax contributions in error on somebody who shouldn't be contributing pre-tax contributions. For those employers who remit via VOIA PayCloud within Sponsor Web, and that's the majority of you, the employers will receive a real-time edit and not be allowed to submit pre-tax contributions for those participants that you've told us are over the $150,000 who have that MRC indicator and they've reached their standard contribution limit. So if somebody has contributed up to the $24,500 and they've got that MRC indicator in place, any contributions remitted pre-tax will basically be prevented from being remitted. The employer will enter the contribution amounts. The VOIA PayCloud will edit that batch to see if there's any errors. If there are errors in the batch, it will not say ready to post. Instead, it will say contains errors, and the employer will not be able to submit that file until they correct that error and switch those contributions to raw for those participants who have that MRC indicator. The important note there is, if we don't know who these people are, if the employer does not submit that MRC indicator, we have no way of knowing. And so those catch-up contributions will get processed as normal, and we don't have a way of preventing them going pre-tax into a participant's file in error into their account. For those of you who remit SFTP contribution files, and that's just a small number of you, you do FTP contributions files for your participants, you can either put that MRC indicator into VOIA PayCloud through the Sponsor Web Portal, or you can provide VOIA with an MRC file. And we've got a file format that we can provide to you. It'll be sent out to all of you. But the MRC indicator file template is available will be sent to employers. It's on our website, and I'll be showing you where to find that at the end of the presentation here. Employers that submit a contribution for a participant who had that flag that exceeded the standard contribution limit, they'll be notified before the payroll can post. And the Voya payroll team will work with those employers to return the funds, and the employer will need to correct the contribution in their payroll to ensure that that participant has an accurate W-2 reporting. And again, just a reminder, if we don't have that MRC indicator, if you don't provide us with the file, if you're an FTP employer, or if you don't put that Y on those participants through Sponsor Web, we won't have any way of knowing that these participants are getting pre-tax contributions into their file in error, into their account. So the responsibility here falls on the employer and the employees as well. So it is the employer's responsibility to remit Roth age-based catch-up contributions to those affected employees into their MNDCP account. What that means is if an employee is contributing pre-tax dollars, partway through the year, they hit the $24,500 normal limit, the employer needs to switch their contributions over to Roth for the rest of the year. Now your feedback file will still show pre-tax for those employees, but you will need to remit Roth contributions and take them out of their paycheck accordingly. January 1st of the next year, they need to be flipped back to pre-tax contributions if that was the employee's intent to be contributing pre-tax. So it's on the employer to switch those contributions from pre-tax to Roth and then back to pre-tax the first of the next year. Now, it's not required that you aggregate salary across employers. If you've got an employee that's working for you and you're a city and they work for a county or vice versa, you don't have to worry about the salary they earned at another employer. It's just the salary they earned with you. However, if you have multiple deferred comp plans, you are required to aggregate salary and coordinate Roth age-based catch-up contributions if the employee contributes to multiple 457 plans. So if you have the Minnesota Deferred Compensation plan and you've got an out-of-state provider for a deferred comp plan, an out-of-state corporation running one of your deferred comp plans, you need to make sure that that employee isn't doing 20,000 to one and 15,000 to other, and it's all pre-tax. You need to make sure that if that MRC employee who made more than $150,000 is contributing to both, once they hit 24,500 total across those deferred comp plans, anything to either plan after that has to be Roth. There is no requirement that you need to aggregate salary and contributions if that employee contributes to a 457 and 403B. 403Bs are typically only available to schools, nonprofits, and so not all of you would even have access to a 403B. But if you do, you don't need to be concerned. You just need to focus on contributions to 457 and the 457 limits, contributions to 403B and the 403B limits, but they are separate plans with separate rules.
Dave.
Yes, Mark.
This is Mark. We had a question that came in through the chat. Someone was wondering if participants need to apply for or elect age-based catch-up contributions. And the answer is no, they do not. So any participant who turns over age 50 or age 60 to 63 can automatically contribute up to the limits. We stop them once they hit those new limits. They don't have to apply for it. They can automatically just contribute up to those limits.
Yeah, that's a great point. There's no application needed to utilize those age-based contribution limits that we saw on that chart. So what are some key takeaways and action items here? Well, identifying and monitoring who these employees are. Incorporate the contribution limit monitoring for those MRC participants. So figure out which of your employees had more than $150,000 of FICA wages in 2025. Put that MRC indicator flag within Voya Pay Cloud, and or send in the file if you're an FDP employer starting January 1st. And so identify the wages. Who are those MRC participants? Put that flag on their file, provide that to Voya so we can all keep track of who these employees are. And if you use a payroll vendor, a third-party administrator for payroll in any fashion, make sure you're communicating with them. Contact them. How are they accommodating the requirements of this provision? Whose responsibility is it to identify the employees and put the flag in the Voya system? Make sure you're having those communications, because it really is the employer's responsibility to make sure we comply with this. We are all in this together, working on this new provision that is somewhat complicated, and we will have resources that I'm going to show you in a minute to help you figure this out. This resource page is some links, but I'm actually bring you to the MSRS website and show you where to find a lot of these things. So we have a user guide, which shows you how to add that MRC indicator flag within the Voya Pay Cloud in Sponsor Web. So we've got a document that shows you how to do that. The file format for the FTP employers will be sent to those employer contacts via Gov Delivery. And we have instructions on how to do that as well. There will be additional reminders sent via Gov Delivery, reminding you that we have to start implementing this January 1st, that we need to put your those MRC indicator flags and so forth. A summary of this presentation and these provisions, we've got a sheet on that, and of course you've got the copy of this presentation if you'd like to have it. That's on our website. A recording of today's presentation will be made available, and of course contact us if you need more information or have questions about anything. Let me switch here to showing you on our website where to find some of these resources. Okay. So first of all, if you start out on the MSRS website, mnretire.gov, important link here in the upper left corner is for employers. This has tons of information for you about how to remit your payrolls and what are the rules for healthcare savings plan contracts if you participate in our healthcare savings plan. Scroll down a little ways to the Secure Act 2.0. And when you access that, you have basically all the details of this provision, this law that was passed back in 2022. And so there were provisions that were effective right away in January of 2023, some in 2024, and this one effective in 2026, the catch-up contributions, age-based catch-up must be raw for those high-income earners. There's an overview of the provision, the limits, an explanation of how this is going to affect employees. This threshold here, this is now $150,000. That was $145,000 when the law was passed, but that's now $150,000. This first link here, the employer job aid. This is a summary of all the things that we've talked about today. If I open that, we've got basically all the main talking points about today's provision that we've covered. What you need to do, what the limits are, what your action steps are. We've got the contact information for payroll support. This link here, view MRC indicator file template. That's for those who are FTP employers. If you want to see what the file template looks like, if you want to submit or give us those MRC indicators that way. Let me go back here. So that was the employer job aid. That's basically a summary of everything we've talked about today. This is instructions. This next tab here is instructions for how to put that flag on participants or employees' accounts. So log into the Voya PayCloud through Sponsor Web, and it walks you through how to put that MRC indicator. And then today's presentation here, all the slides are here under the webinar presentation. And then coming soon, we'll have the recording of today's presentation if you want to review anything. With that, let's open it up for questions. If you have a question, we've got some in chat, so I'll see if any of those need to be answered here. And go ahead and raise your hand. We can call on you
Dave,
and you your question that way as well. Yes, Mark.
David, so a question in the chat. I would like to clarify if you could go to the presentation again and bring up the age-based limits page.
Yes.
There is a question about what happens if a participant turns age 64? Are they still subject to the FICA earnings? Once a participant turns age 64, they revert back to the age 50 and over catch-up contribution limit. So if I'm 60 to 63, I can contribute an additional $11,250. But once I'm 64 and over, I only can contribute the additional $8,000. So then it's still an age-based catch-up contribution. So from age 50 till they retire, it's an age-based catch-up contribution. So they have to abide by those limits.
Yeah, and it's a great nuance to point out. The year that somebody turns 64, that whole year, they go back to that age 50 plus limit, the 32,500. But it's still, again, subject to this Secure 2.0 603 provision. Other questions that were in chat?
Someone just asked, do we have to set up employee accounts differently when they are over age 50 and are participating in the catch-up portion? I assume they mean the 3-year catch-up provision, but are under the salary amount of $150,000. So I would say if they're under $150,000, you don't have to worry about their FICA salary or their FICA wages, but they do have to apply for the 3-year catch-up provision to contribute additional.
Right. Yeah, if all of your employees or whatever employees you have are under the $150,000, then this provision doesn't apply to those employees. There was a question about it says 145,000 on our website in a couple places. It's 150 now. We just got that number 2 days ago, and so we're working on updating everything. We were working with 145,000 for the last 3 years, preparing for this. Now it's 150 for 2025.
One of the questions about what about overtime, if that puts them over the limit? If their W-2, what is it, box 3, FICA wages is 150,000 or over, that includes overtime, then you have to include them.
Yep. If it's FICA wages, it's FICA wages. It doesn't matter if it was overtime or regular time. It's subject.
I love this question because I want to know the same thing. What was the reason to implement this change? Why does the IRS and Congress do things? I don't know. Dave, Adrian.
Yeah. So often when legislation like this is passed, there can be trade-offs, and often they look for ways to fund other provisions. So there may be provisions that are of tax benefit to some employees, participants, citizens, and sometimes they have a trade-off where there is a tax consequence to other groups. And this is a way that they believe that more income or revenue will be generated for the government by having Roth contributions for a certain population of people. And so it was, I'm sure, all done behind the scenes. Well, however they do it, when they were creating the recipe for everything, this was a revenue generator provision. I saw a question in chat, is 150 for the 2025 wages or 2026 wages? The $150,000 is for the wages earned in 2025, but applied to their 2026 contribution limits. So it's the wages earned in 2025 is $150,000. Question came in, if an employee is under $150,000, can they contribute the additional $8,000 and $11,250? Absolutely. These contribution limits are for everybody, but it's those with the higher salary that have to do Roth for the age-based portion, that additional 8 or that additional 11,250. But everyone under that salary, they can contribute whatever they want if they qualify.
Yeah, there's a question. What if you hire someone mid-year? A full year salary, they're going to earn over 140,000, but last year they came from another employer. They earned over 150,000 because part of that salary was with another employer. You only have to worry about salary at your employment with you. So you don't have to worry about another employer's salary. It's just salary that they earned with you. There was a question about communication being sent out to GovDelivery. GovDelivery is how we communicate with our employers. So we communicate all this information via GovDelivery. So you receive emails from MSRS via GovDelivery, and we've been communicating like we communicated this webinar. We'll send out something in a few weeks with all this material and telling you where everything is on the website and a host of other information. So that's how we communicate with you, is through GovDelivery.
There was a question in chat about what if an employee is a sheriff's employee and doesn't have Social Security wages. We did cover that, but to reiterate, if you have employees who are police officers, sheriff's department, firefighters, state patrol, and they don't have FICA wages, then this provision doesn't apply to them.
Yeah, the provision also does not apply to anybody in the MSRS unclassified or plan or the general employees pension plans. Those plans are not 457Bs, 403Bs, or 401Ks.
There was a question here. What happens when the employee's combined income for spouse salary is over the contribution limits for Roth? Okay, let's break this down. There are income limits for contributing to Roth IRAs. This is not an IRA. There are not income limits for participating in the Roth Minnesota Deferred Comp Plan. So those are two separate programs with two separate rules. We don't have income limits. If you're an employee of a governmental subdivision, you can participate in our plan up to the limits. There's no salary there's no salary exclusion like there is with Roth IRAs. But those with salary over $150,000, those employees, if they want to use the age-based catch-up, they have to do Roth contributions after the standard contribution limit.
One thing we did not tell people, Dave, is when you add that MRC indicator in the Voya sponsor web portal, it's not available till after the first of the year. You wouldn't enter it now anyways because you don't know their year-end 2025 FICA wages yet because the year isn't over. So in 2026 in January, you'll be able to see that indicator in Voya sponsor web.
Yep, so that'll be available in January that you can start adding those MRC flags.
There's a question about combined income with the spouse. You don't combine incomes with spouse's salaries.
Yeah,
these are individual accounts.
That's Roth IRAs, so that's totally different.
I didn't multitask very well, Dave. Sorry.
Oh, you're doing great, Mark. Thank you. We're all in this together. Is this a task that is to be done annually then? Well, that depends. If you have the same employees next year that are over that salary, then that flag will remain. That MRC indicator will stay on those files, but you're gonna want to make sure you check. And make sure you check that you don't have other employees that now are subject to these new rules. So it should be reviewed annually.
And just to add to that, David, the salary requirements are going to change annually too, right? So, somebody this year might meet the salary requirement, but not next year, or vice versa. So, to David's point, you'll definitely want to continue to review those every year.
Yeah, oh, that's a great point, Adria. They may fall into the other category next year if they're close to the cutoff. So yeah, they should be reviewed every year.
Right. And the flag can be updated in both directions the same way. So if you have someone who qualifies for, or meets this limit this year, and then based on their compensation for next year, it's not applicable, you can go in and remove the flag so that contributions can be processed as normal.
All right, here's a great qualifying question here. If somebody is 49 and turning 50 during the coming year, do we flag them? If their salary was more than $150,000 in 2025, yes, because it's the age that you turn or attain in that year, the age you are at the end of the calendar year, that applies to whether or not you can utilize these catch-up contributions. So somebody turning 50 in 2026 should be flagged if their salary is over $150,000 in 2025.
There are questions about how employees and participants will be informed of this. We only can inform those participants and communicate with the ones that have the indicator. Those are the only participants we know that are making over 150,000 that it's affected. So it's sort of a joint communication between the employers and us as the plan sponsor.
There's a question about, go ahead, Mark.
No, go ahead, Dave.
How will
We're probably
we
doing
be
the same thing
informed if they elect pre-tax or Roth for the standard contribution limit? Are we notified by MSRS of the election? Yes, there's and Adria, you can help me with the name of the file, but there's a feedback file or report that is available through Voya Pay Cloud, through Sponsor Web, where you can see employee elections and what contribution amounts they've elected, and that will tell you if they've elected pre-tax or Roth after tax. But for those affected employees, for those making more than $150,000, it's your responsibility as an employer to switch them to only Roth once they've hit the standard contribution limit. And make sure you put that MRC indicator flag on their file.
Yeah, participants have multiple ways they can change their contribution amount. So whenever a participant enrolls in the plan, or whenever a participant changes their contribution amount, whether it's through our service center or through their account online, we feed that information back to the employer on a weekly basis. So anybody during the week that changed their contribution amount is fed on a report back to the employer. And then you take the information from that report to update your HRIS system in their contribution amount. If you need help understanding how that process works, where to find it within Voya Sponsor Web, give our MSRS payroll support a call. They'll tell you. There's also information on our employer website. Will the Y flag, the MRC indicator flag, stay in the Voya system until it is removed? Yes, it will. So we're going to assume that they're still earning over 150,000. Do we need to do the indicator flag at the beginning of the year? It's preferably yes. You can always update it anytime throughout the year. So you may not have someone that you know is going to earn 150,000. They may get a huge bump in pay or a promotion that's going to put them. You can go in June or whatever and change them to a Y. How long do new enrollments get sent on filed to new employees? as I said, every week, if we get an enrollment for a person, that is sent every Friday evening. So for that week, so you will receive a feedback file weekly if there are changes.
Yeah, and if you're not seeing that payroll feedback file within your once you log in, give our payroll support team a call. We can show you where to find it. If you're not getting an email notifying you that that is available, you should be checking every week to see if there are any changes. But if you're not getting an email reminder or notification, you can contact our payroll support. Sometimes those emails end up in your junk folder or are filtered out by your spam filter, so they aren't always getting to payroll folks. But call us if you have questions.
Yeah, if to get our payroll contact information, if you go to our employer website, that is employers.mnretire.gov, G-O-V. So employers.mnretire.gov. There's a contact us link, and it'll have the MSRS payroll support number. And you can find our information, our contact or email information there.
Wow. Thank you all for joining today, learning about this new provision, working with us to make sure we're all in compliance. Sure appreciate that you joined us today. Thank you, Adria and Jim from Voya, for your technical expertise. Thank you, Mark, for helping run the webinar today. And again, contact us if you have questions. The recording of this presentation will be available on our website coming soon. Have a great day, everyone.